So what is Bitcoin today? It used to be this wild west of overnight millionaires and crazy market swings, but that's changing. Wall Street and the big global institutions, they're the new players in town, and they are literally rewriting the rules of the game. So let's dig into what this new era of Bitcoin really looks like.
Think back to 2017, right? It was pure retail mania. Everyone was talking about ICOs, and it was just chaos. Fun, but chaotic. Fast forward to today, and wow, it's a completely different world. This isn't about hype anymore. It's about steady, calculated moves by major financial institutions. And the one thing at the center of it all? Yep, those spot Bitcoin ETFs.
Okay, so here's our game plan. We're going to start with how Bitcoin landed on Wall Street. Then, we'll peek into the professional investor's toolkit. After that, we'll look at this wild connection between mining, AI, and the network itself. We'll take a trip to India to see global adoption in action, and then we'll look ahead to see what 2028 might hold.
All right, let's dive right in. Section 1. Bitcoin hits the big leagues on Wall Street. And really, the whole story of this new era boils down to three little letters: ETF. The approval of the spot Bitcoin ETFs in the US, that wasn't just another news story. It was the event that changed literally everything.
And you don't have to take my word for it. The data tells the whole story. Look at this. The ETFs didn't just open the floodgates for more money, though they definitely did that. Daily spot volume jumped up by 40%. But here's the really interesting part. They also brought a sense of calm. The annualized volatility, which is basically just a way to measure those wild price swings, it actually decreased by 16%. So what does that mean? It means more trading, but with a whole lot less of that roller coaster chaos we used to see.
So this new setup has completely changed Bitcoin's personality in the market. You've got the ETF, which is like this perfectly regulated, easy-to-use package that lets traditional capital just pour right in. And because of that, we're seeing Bitcoin's price move more in sync with big stock indexes like the S&P 500. What's also fascinating is we're seeing these institutions show off their diamond hands. They weren't panic selling during dips, they're holding on. The big takeaway here is that the narrative is shifting. Bitcoin is acting less like a safe haven and way more like a high-growth tech stock.
Okay, so if the big money is playing, you know they're not just guessing. They have a professional toolkit. So let's pull back the curtain and look at the actual metrics that matter, the data these pros are using to make their moves. And first up is one of my favorites, Bitcoin dominance, or just BTC.D. It sounds technical, but it's actually incredibly simple. All it does is tell you what percentage of the entire crypto market's value is parked in Bitcoin. The best way to think about it is like a heat map for money flow in the crypto world. It shows you exactly where the capital is heading. And here's how traders actually use that map. It's all about reading the sentiment. When dominance climbs high, like over 60%, that's a classic risk-off signal. It means money is flowing out of riskier assets and into the relative safety of Bitcoin. But when it dips, say below 45%, that's when things get exciting. It's a risk-on signal. It's the green light that traders look for to start hunting for gems in what they call altcoin season.
Okay, next tool in the box, the MVRV ratio. Now the name sounds super complex, right? Market value to realized value, but forget the name. Just think of it as a giant profit and loss meter for the entire Bitcoin network. It basically compares the current price to the average price everyone paid for their coins. So in one number, you can see if the network as a whole is in profit or in loss. It's an incredibly powerful shortcut to understanding market health.
And this is where it gets really practical. Look at these thresholds. When the MVRV gets above 3.0, alarms start going off. The market is overheated. That means the average person holding Bitcoin is sitting on a 3x profit. The pressure to take some of that profit off the table becomes immense. But on the flip side, when that ratio drops below 1.0, the market is underwater. The average holder is now losing money. And historically, that has been one of the most reliable signals that we're at or very near a cycle bottom.
All right, let's switch gears a bit and talk about the very foundation of the Bitcoin network, the miners. Because there's this really fascinating, unexpected collision of worlds happening right now between Bitcoin mining and the AI boom. It's completely changing the economics of how the network stays secure.
It's basically a 4-act play. Act 1, the 2024 halving happens, and bam, miner revenue from block rewards gets cut in half. Profit margins get squeezed hard. Act 2, at the exact same time, the AI revolution explodes, creating this desperate, worldwide hunger for data centers and cheap electricity. Well, guess who has massive data centers and access to cheap power? Bitcoin miners. So Act 3, they start to pivot. They're repurposing their infrastructure to service the AI industry. And the final act, the big implication, the security of the network is evolving. It's going to rely less on those block rewards and more on transaction fees. So we've looked at Wall Street and we've looked at the network's plumbing. Now let's zoom way out and go global. We're going to use India as our case study because it's just this perfect example of where institutional money and grassroots adoption are meeting. You want to talk about a regulatory roller coaster? Look no further than India. I mean, they went from a full-on banking ban for crypto in 2018 to the Supreme Court literally striking that down to then slapping a huge 30% tax on everything in 2022. It's been whiplash. But through it all, the market there has just been incredibly resilient. And now it looks like they're finally starting to move towards a more stable, globally aligned framework.
So what's fueling this fire, despite all the uncertainty? Well, it's this powerful mix of factors. You have a massive young population that gets it. They see this as their generation's asset. And get this, institutional growth is up an insane 93%. We're also seeing this growth explode outside of the big megacities and into smaller towns. And maybe most importantly, you've got these developer hubs popping up. India isn't just a consumer of crypto anymore, it's becoming a builder.
And this quote really just says it all, doesn't it? It perfectly captures that massive cultural shift. For this digital native generation, Bitcoin isn't some fringe weird thing. It's a ticket. It's participation in a totally new global financial system. It's about having a seat at the table.
Which brings us to our final piece of the puzzle, looking ahead, forecasting the 2028 horizon. So where is all this heading? Let's take a look at what the big institutional analysts are pointing to as the major drivers for the next cycle.
The pros are watching three massive trends. First, something called RWA tokenization. That's basically taking real-world things like buildings or stocks and putting them on the blockchain. Huge. Second is the continued explosion of stablecoins. I mean, we're talking about a potential $1.2 trillion pool of liquidity just waiting to rotate into assets like Bitcoin. And third, this one would have sounded like science fiction a few years ago. Actual sovereign nations are now seriously discussing holding Bitcoin in their national reserves.
So the big question is, what could this do to the price? Well, let's ground this in some real-world analysis. Take a look at these projections from a major bank, Standard Chartered. They map out a path here. Continued ETF money in 2025 pushes it to 200K. Then the real-world asset integration kicks in, taking it to 300K in 2026. And by 2028, after the next halving cuts the supply again, they're projecting a price of $500,000 per coin.
And all of this leads to a really profound question. Could the old 4-year cycle, the one driven by pure retail FOMO and panic, be dead, or at least dying? Some analysts think we might be entering what they call a super cycle. Not those insane peaks and valleys, but a steadier, more sustained growth driven by long-term institutional accumulation. And that leaves us with the ultimate question, doesn't it? When you trace this whole journey we've just covered, from a niche digital experiment to a serious tool on Wall Street trading desks, it all funnels down to this one idea. Is Bitcoin just a speculative asset, a high-stakes bet, or is it actually maturing right before our eyes into a fundamental piece of the future global financial system? That right there is the multi-trillion-dollar question.